Hello ma'am, my name is Giselle Sigara and I am from Group A, and my topic would be about the anomalies and the initial public offering. So first, let's start with anomalies. Anomalies, these are findings that are inconsistent with the joint hypothesis that markets are efficient and risk and return are related to a particular asset pricing model. So anomalies, it happens when the actual result under a given set of assumptions is different from the expected result predicted by a model. And there are two types of anomalies in finance: the market anomalies and the pricing anomalies. So, market anomalies, these are distortions in returns that contradict the efficient market hypothesis. So, for example, is the January effect, which is a very well-known anomaly. And the idea is that the stocks that performed inefficiently in the fourth quarter, let's say in 2019, tends to outperform the market in January of the next year or in 2020. And the next example is the September effect, which it refers to historically weak stock market returns for the month of September. There is a belief that the investors' returns from their summer vacation in September, and they are very eager to lock in gains and their tax losses before the end of the year. And the last example is the October effect, which is a perceived market anomaly that stocks tends to decline in the month of October, since it is considered mainly to be a psychological expectations rather than an actual phenomenon, which most of the statistics goes against with the theory. And some of the investors are really nervous during the month of October because most of the dates of the large historical market crashes occurred during this month. And the next type of anomalies is the pricing anomalies. This happens when something is being priced differently to how a model predicts it will be priced. Let's say, for example, is a stock that has been overpriced or underpriced rather than its predicted price. About the initial public offering or the IPO, which is the process of offering shares of a private corporation to the public in a new stock issuance. So the public issuance allows a company to raise a capital in the public investors. And this could be a young company or an old company which decided to be listed in the SEC, and hence they open their doors to the public. So how does an IPO work? So prior to an IPO, a company is considered a private, right? So as a private company, the business has grown with a relatively small number of shareholders, including the early investors like the founders, the family and friends, along with the professional investors like the venture capitalists and the angel investors. So when a company reaches a stage in its growth process when it believes it is matured enough for the rigors of the SEC regulations, along with the benefit and the responsibility to the public shareholders, it will now begin to advertise its company to the public. So now the importance of an IPO is that it provides the company an access in raising a lot of money, and also gives the company a greater ability to grow and expand its business. With the increase in transparency and the share listed credibility, it can also be a factor in helping the company at better terms when they seek for a borrowed funds. So I guess that would be all about my report, ma'am. Thank you.